This is our 21st episode with Patrick. Patrick Reid. How you doing, Patrick?
I'm very well, Alan. How are you? It's the day
Good.
after the big Fed meeting, so yeah, we're just going through all of our clients' trades, and we had a really good night. So yeah, I'm very happy.
Yeah, then it's great. So, what is your story? How do you
My
involved in
story,
the
wow,
financial markets?
yeah. Well, my story really is I'm a late career changer, and that's what we do. That's
At what
that's who we
age?
help. At 38.
38.
Yeah, so I wasn't born to be a trader at all, and I I kind of I was in a career, um, it was a really good career actually, but it was just something a bit too safe, and I wanted more, and it was difficult to leave because it paid me good money and the people were lovely, but I knew in my heart that life is not a dress rehearsal, right? I wanted more out of life, and I thought, well, this is the age that I just want to do it. And I realized that I came to the realization that if I carried on, I would just not feel fulfilled. And if I made a mistake, changed my career, then that at least I've tried something. I did meet through his wife actually a really big futures trader and who owned a prop desk in the city of London, and we went for dinner. We got on really well, and essentially, I went to see his floor, and I saw the noise, the screams, the squawks, and I just got this incredible buzz, and I was like,
Of all the
"Sign me
charts
up!"
and yeah.
Yeah, I got exactly, and I thought, look, and we spoke about being one of his oldest apprentices, basically. Um, so I threw in my safe job and I got down to it. I was surrounded by 21-year-olds and I was 38 at the time. And I just thought, you know what? I'm just going to do this. And I really just got thrown on the desk. It was a German debt desk. It was the Bund pit. So I was on that, and I just learned on the desk basically, um, and that was it. It was just I knew that my second week in, I was almost like I did a little cry in the loo, and I was like, oh my god, what have I done? I've left this really safe, nice, lovely job, and I'm in the lion's den of a futures pit in the heart of London, near the Bank of England on Old Broad
but
Street,
but you-
and
but
I
you
was
started as a proprietary trader.
yes, yeah, yeah.
So
So
it's
I
still a job. Like it's still
yeah, yeah, absolutely, yeah, yeah. So I got about I don't know about 50 odd K with me, and I rented the desk as a local. That's what most futures traders are, and I'm trading my own account. I remember thinking, okay, well, this has got to work. And sometimes when there's so many different types of traders, and I've only known that way. Um, and in many ways, it makes you have to be a good trader because you have to survive. You've got your rent of the desk, you've got Bloomberg, you've got all this stuff, charts, and you just have to survive. And what I did to help me in the early days was look, I had a bit of savings that I lived off, and but I also did a bit of freelance at the weekend. So I kind of made my capital golden. So I didn't want to dip into that. I didn't want to worry myself too much by having to earn money to pay the rent and that kind of thing to live off. And I think that's one of the mistakes traders have today is they say I need to make £1,000 every day or whatever it is because I need to pay for the next mortgage or I need to pay for this holiday. That's not
and
the
they
right
don't
way to do
have
it.
another income streams. Cool.
Yeah,
Yeah.
exactly. So I always say to my clients, don't borrow money. Leave yourself some runway. Keep your capital golden. And there are loads of different ways to do that. You can do a funding account. But always start on the demo. Don't start with your own money. I mean, the amount of times. Sorry, digressing a bit here, but the amount of times people come to you and go, um, I'm trading my own money self-taught. I've got 20K and I've lost 15 of it. What do I do? And I'm like, it's a little bit late to ask me that because you've kind of done it yourself. But coming back to your question, I feel that I set myself up to fail, but I get myself a year runway, and I experienced some of the highest volatility. It was around the Greek crisis back in 2011, 2012, and I really um, learned so much, and I got myself a mentor, someone who'd been there and done it with loads of markets, and I learned from them. I read every single book, every manual, every white paper, every bit of research, and back then, this is bizarre, yeah, but back then you could go to the library and get research and white papers, and there was a lot less online. So I just loved that. I went, in a quiet spot in the library, and I just went through all this historical financial crashes. I loved the subject. I lived and breathed it basically, and then obviously I had an extra sort of freelance work from my old job just to sort of help me out, just to kind of have a nice contrast and keep the wolf from the door. But that was the year I learned really. And then, by the end of that year, I was kind of like make or break. Should I carry on? And then obviously things went really well. My second year, made good money, and then I moved to spot. I changed from the futures desk into trading spot because I'd always gravitated to FX, and I wanted to know what spot traders were doing, how they thought. People who had headed up banks, some of the alpha banks, like
Yeah.
Goldman's or HSBC, Goldman's, Morgan Stanley, or JP Morgan, and even the bigger kind of juggernaut banks like HSBC and Citi and BAML and stuff like that. So I wanted to learn all that, and then I started trading, for a liquidity provider for a little bit, and that's where I met Adam, my business partner. He was my boss, and I learned spot, and I did really well there. And that was and then about 8 years ago, we decided, Adam and myself, he was my boss, and decided to set our own company up, Adamis Principle, and essentially we wanted to. I was on a bit of a mission to help late career changers. I didn't know it at the time, but I wanted to give opportunities to people like myself that maybe you've done well in a job. You realize you want to be a professional trader, but we do it I wanted to learn from institutional level, not the retail BS you get. So it was really a mix of that, and then we've had our company now nearly 8 years, and the time has just flown. And that's where we formed Adamis Principle, and I head up the mentoring arm, and we teach people how to trade and get them futures desks, and we've got a little recruitment arm as part of the company. Adam looks after that, so we're very well connected in banks and hedge funds. I'm buy side, Adam's more sell side, and essentially, we have we still trade obviously, but we have global clients from senior staff at BlackRock, JP Morgan, Morgan Stanley, UBS, and they want to be traders, or they want executive mentoring to make them better in their job, basically. So that's what I head up at the moment, and I love it. I love my job. I love markets. I love helping people, and I love traveling to see them. I've just come back from Amsterdam from the Trade Tech event as a moderator, and I was honestly, some of the panels were just, the talent is incredible. One of the panels, there was a real money fund, and I was a moderator, and we were discussing all kinds of things in futures and NDFs, and the AUM 324 billion euros. So for me, I love doing things like that, mixing with the very high kind of talented people. So I do that. My job enables me to do that, but also I just love meeting new traders who think they can't smash down that wall of getting a job in an institution, or they just want to change their career to be profitable or whatever. And we do live and breathe markets. So that's me in a nutshell in my journey. It's and it's never ending. I mean, we've got great exciting plans for the company. Markets are always giving us something new to talk about, and we see the opportunity in that.
Yeah. So, but don't you need a financial background, some at least financial background, to transition from a proprietary trader to retail trader? If you teach someone, I mean, to trade in the market successfully, you do need in some degree, a financial background, isn't it?
No, that's what I did. So we teach you that. That's the key thing we do, right? So I had no experience, and I was just very lucky to find a really good mentor. And essentially, you do need grit, passion. You need to be not scared of numbers, but I did not have any experience. That's the key thing that we do. Our mentoring gives you that. And it's all in us. I do feel that the fact that you want to be a professional trader means that you're really interested in it. So that is key, just to have that passion. And you'll find that what we do is we make the complex quite digestible. You can interact with us every day. We talk to our clients every day, right? So it's like, oh my God, what's this? What's that? And risk management is really the underpinning key. And with some simple tools.
But what do you teach first? You teach first the fundamentals, the theory behind all the financial markets. Like, you teach how it works first, and then you go to practice to trading.
It's a live desk experience. So you'll get a mix of how fundamentals move markets, obviously, and the reaction in cross assets. But you also get risk management as well. So we do live, what's with all the live charts, technicals, and it's basically how I was taught. This is not academic. So really, it's a live experience, and we do that through live teaching, and we do that. But we also have videos to go through the history, the big events, some of the deep dives on say inflation, on emerging markets and things like that. That's on video recorded, that you can watch anytime you want in our vault, in our platform. But we mix that with the live as well, and together it's really magical because that's how I do it. When I hit the desk at 6:30 for the Bund Open at 7, I was like full on looking at markets live. But then when I went home, I was in the library. I was looking at all the literature and looking at all the key historical events. So that's what we try and replicate, that feeling of both live and also self-study at home as well. So yeah, look, sometimes, coming back to your question, we'll do a deep dive on this history of Japan economics, like the lost decades from the Plaza Accord in '85, right? So we'll do, all the big crises like 87, 92, 98 in Asia, the dot-com boom, obviously,
and
GFC.
Then you look how that events affect the markets.
Yeah, totally. So we do deeper dives on that, and we'll look at credit spreads one week, or we'll look at how the treasury curve works with spot effects. We'll look at some of the macro. We just had a big session this morning, for example, on the Fed last night. They do the jumbo cut, but it was quite hawkish, right? So we're talking about what a dove is, what a hawk is, and this stuff. It's very much organic and dynamic, and each day brings you something brand new, and that really engages our traders. And as a result of that, they do really well. We've got an amazing bunch of testimonials with really good results on that. So, we feel that's the best approach. There are other mentors that go down the academic route, and we don't touch that because essentially not to say anything bad about them, because everyone's different. We want you to be a trader and to be in a proper desk. An academic study will not give you that toolkit. So that's really where we come at it.
Yeah, it will just help you.
Yeah.
Yeah. So regarding risk management, like the secret sauce of any trader,
Yes,
can you share
exactly.
your top risk management principles and how they have helped you?
Yeah, sure. Forget 1 to 2% on capital per trade. It just doesn't work for me. That's first of all. The second thing that we use is the 80-20 rule. So 100% is your capital, 20% is your margin, 80% is what you keep golden. So the only amount you have to trade is 20%. When that's gone, you have to stop and walk away. That means you have to look in the mirror and tell yourself you're not good enough. So, but what you do get is you get to walk away with 80% of your capital. That's the key rule. Within your 20% capital, you slice and dice that into trades, right? So we actually have a how to trade like a pro PDF book, and I'll send you the link to this. Once you know how many trades you've got in you, at what clip size with your stop and everything, and your risk reward, now you really understand when you should reduce your frequency and or your clip size. So me, I've got about 12 trades in me, right? Some people might have 20, some might have 50, some might have 5.
20 trades for the 20% capital?
No. So that the 20% could be any amount of trades. You just have to work out what that is. The 20% of your capital is a number, right? It could be anything. Yeah. Let's just say, for example, say you've got 100K capital.
20,000 of that is, I allocate to trading.
Yeah, so exactly. So you only use your 20,000, right? Because that's your margin. And let's just say you're doing 10 lots with a 20 pip stop. Right, so that's 2K per trade. 20,000 divided into 2 is 10. That means you have 10 trades in you at 10 lots with a 20 pip stop. And what I suggest you do is I'll post the PDF doc and it will take you through step by step of this. But essentially, whatever that number is, that's what you've got. And you turn that 20% into physical trades. And that means it's real. You know what? So I've got, say you have 10 trades in you, like we've just done. We've done 100K capital, 20% is 20K. One lot is like $10, right?
Yep.
So 10 lots is 2,000 pounds. And sorry, 200. You have a 20 pip stop, that's 2K, right? And essentially, you've got 10 trades in you because you divide 20K into 2, it's 10. Right?
Okay.
So whatever that, it could be any amount, it doesn't actually matter, but do you feel comfortable with 10 trades in you? That's why I ask my clients, do you want 20 trades? That's fine. So that means you've got 5 lots. You've got 20 trades in you. Do you want 20 lots? That means you've got 5 trades in you. And you do different scenarios and you find the one that you feel comfortable in. Because what that means is each trade, you shouldn't be fearful. So FOLO and FOMO gets removed and you're fine because you know you've got your arms around the finite amount of bullets you have, right? And that's the key thing about risk management, is knowing what you are losing, right? So you act on that. And that could be any amount, but you always just, and it's real because it turns out you go, next week, for example, if I lost 6 trades, I haven't got my head in the sand. I know what I need to be doing something about that. I need to stop trading, put in my process box take a week off. Because it happens, right? I need to
Yeah,
reduce my clip
definitely.
size. I need to reduce my frequency. I need to do all this stuff that kicks in. It's a process framework that kicks in because it's not that I'm a bad trader. It's the market. It just doesn't agree with my trades, right? And that's the key thing. Traders don't. A lot of traders that come to us don't understand that. They just think, the market's wrong, or they just think, they're not good enough, or it's honestly, it's about risk management. You can be very, very good at macro. Like I know some exceptional macro traders out there, but they fail because of risk management. You can be average at macro and really good at risk management, and you will be a successful trader. And the other thing about risk is not boring. It's really interesting because it's not about being defensive. It's about knowing what you're losing and leaning in. You can lean in and out of a trade. So you can. There's this concept that Brent Donnelly. He's one of the guys that I really rate. I mean, we were speaking about Beat. Beat's a friend of mine, so he's obviously up there as well. Brent's great. He does a thing with Elf. He's an ex-PM for bonds, and they do. It's called the macro. The macro trading floor, I think it is. It's a podcast every week, but it's really good. But what Brent was saying, it's this concept of being tight aggressive, and essentially that is so key to good risk management. You can, when warranted, you can be really aggressive when everything in your confluence adds up. When you've got 5 or 6 things that tick all the boxes to pull the trigger. But then when markets are choppy, you just sit back and wait patiently. And that's the concept between tight aggressive. So, coming back to your, top rules, I would say forget the 1 to 2% per trade. It's a guide. It just doesn't mean it. A lot of retail traders just go by that. Forget that. Do your 80-20, as I explained. Be tight aggressive. And just really understand what's in you, how many trades you've got in you, and really then you will not go wrong. You're honestly, it's key to any good risk manager.
Yeah. Can you provide an example? How do you share fundamentals with the technical analysis?
Yeah, of course. Yeah, absolutely. So if you look on, say last night, so we had a big Federal Reserve meeting. We're still in the range on Eurodollar, right? So if you're looking at say Eurodollar, it's bounced off 2 key technical levels. At the moment, we're printing 110, 111.56, right? But we went up to close to that 112, and we went back down to 110.76. So they're big levels for me. They're key technical levels, and despite all of the chaos and the volatility, and technicals still work. The key thing about technicals.
So you look for patterns, basically.
Well, no, you do look where the market is respected. Now, technicals define risk. Macro moves markets, and technicals are not the oracle. They're just places to put your entry in and know where your stop is and where a potential reward will be. Technicals don't move markets. So that's the key thing. If you understand that, it's really, really crucial. But you have to have both. You have to have both technicals because your risk management, but also macro because it moves markets. And yeah, both. From day one, I've always used both together. There's no way. I haven't met massively successful traders who only trade technicals or only trade fundamentals.
But you do something that is like, the 60% fundamental and let's say 40% technical.
It depends,
so
really.
So it's more leaning on the fundamentals or it's more leaning on the technical side?
Well, no, I'm really fluid, actually. Sometimes you'll get 3 big levels coming together, and then I'll go, you know what, that's just so juicy. I really love that level. And then I'll look at the macro and I go, does that support it? I'll still trade it anyway. And sometimes the other way, I'll go, look, there's a shock hike in some central bank, I will just, I'll be buying that asset, and then I'll kind of work out a technical where I'm going to be stopped out. So fluid, nimble, flexible. Those are the key things. In the weighting, always have your stop and keep that secure. Don't move your stop. But with regards to the weighting of the macro and technicals, I would say it's always changing, it's organic, and it's very nimble.
Got it. So, and by the way, you've been an institutional trader. What are the big disadvantages that retail traders have? You know, because institutional traders have the data, they have all the information they need, and the retail don't. You think that retail traders have at least some advantages?
Yes and no. Look, there's this really incorrect concept or belief that institutional traders run everything. They don't. The data's there for everyone. Institutional traders have a phenomenal work rate. They're very good risk managers, but they also have their own problems. Sometimes they have to trade something, or if they miss a trade, they get their boss on tapping them on the shoulder.
So they have to trade. They have to.
Sometimes, yeah, they have to, yeah. Or if they miss a move, you're going to get, the head of desk going, "What the hell are you doing? You missed out, right?" They have a lot of money, and obviously, within the institutional space, there's a lot of different types of traders. So you get buy side and sell side. So the sell side are basically, a lot of that is flow and execution, but there's a bit of problem there as well. Not so much because of post GFC, but there's problems with that. It comes with different challenges. You're trading much bigger size. You need to get some flow done. Get an execution from a client. Say that's from Apple. They need to hedge out some multi-billion-dollar deal they're doing, right? So you have to get that done, but you don't want to because it's a bad price. And if you get a bad price, you get it in the neck, right? So there's that stuff going on. But there's also a bit more freedom, and the numbers are a lot bigger, but your risk management has to be a lot better, a lot tighter. So you've got a bit of that. And then on the institutional space, on the buy side, you've got directional risk. You really are risking. And you could, that comes with a whole different kind of pressure, because you have to perform. If you're in the hedge fund space, then you really have to satisfy your investors. Hedge funds, a lot of that investment is from the owner as well, or co-owners. So you really have to. That's your own money, right? So there's that pressure as well. And if you look at the swings of, say, one of the big players for me is a hedge fund called Rokos, ex-Brevin co-founder. And it quarterly swings up and down billions of dollars in percent terms, up 2 digits, down 2 digits, and that has an effect on your mental health, right?
Yeah.
So there's problems there, but essentially the data nowadays, is available and readily available. It's not the problem about the data; it's about how to interpret that data to make it tradable macro. Now, that on the institutional side, if you flip that to the retail side, the problem with retail traders is they think the institutions are against them. They're not. They've got better things. They don't care about stopping you out in your little account. They've got bigger fish to fry, right? So retail traders have this mindset, oh my God, the banks are against me, this, that. It's utter rubbish, right? So the retail side, the worst thing is the work rate. Most retail traders are lazy, right? The ones that are lazy are also really bad risk managers. They just don't understand it. I gave you the 80-20 rule. Many retail traders don't even know what that is. They think risk management is being boring and safe. It's nothing to do with that. And they don't put the work in. They just gamble, It's just like not. That's why 80% or 83% lose, because they don't put the work in. They can't. They over leverage. They expect to. They want to turn 10,000 into 100,000 in 1 month. And they just get upset. They revenge trade. They let their
They don't
emotions.
have the patience to sit and
They
learn
don't
the
have the
stuff.
patience. Exactly. they'll go out to the pub on a Friday night, come back, make some big trades, and lose all their money, or they'll not put a stop in. I mean, last 2 months, 4 prospects came to me and said, we don't do stops there for the week. And I was like, I can't help you, right? So, and retail traders think banks don't have stops. That's utter nonsense. Everyone has a stop. It's a place where you know you're wrong. So I would say retail traders have never had it so good, but it requires hard work and finding a mentor. You can't do it yourself. I mean, look, this is my game, and I'm a mentor, and that's what we do in our business. But really, if you're not looking for mentorship, then really be careful, because essentially an institutional trader has been there and done it on big major swings with a lot of money, so we know what it feels like. And if you're trying to be self-taught, it's just going to take a very long time. And it's not that you're not bright; you just haven't had the experience, and you don't know the why. The why is what actually moves markets. So, and that's the big difference. But I'd say in the last 3-4 years, we've seen a lot of overlap between the kind of savvy retail into the institutional space, and this is kind of our ideal market as well. So we help people like that. So maybe you could be, you might work for a broker, or you might be in the finance industry but not a trader, or you might be really. I mean, I've met there's 2 guys that I in the last 3 years I've signed up who are retail traders, and I'm moving them into the institutional space, and they are phenomenal. Why? They turn up and ask questions every single day. They are passionate. They've got grit. They know how to manage their risk, and they've done very well. So these are my kind of star traders. So yeah, they do exist, but those are the sort of. There's a lot of myths out there about the institutions and how they're pulling these strings and all that stuff, and it's just not true.
So I want to ask you this: what do you think about backtesting? Backtesting strategies.
Great.
What do you think about it?
Yeah, absolutely. Of course, absolutely. It's just part of your toolbox. I mean, you need to know what happened previously. On the quant side, backtesting is absolutely crucial. Yeah, I mean, look, you need to know, whether you're backtesting with a model or you're backtesting with your own discretionary toolkit. Yeah, you need to know what move markets and why, and reaction functions. So yeah, absolutely.
Cool, because we're developing now a product for the retail traders, and I'll have to talk to you later. So it would be really interesting. So by the way, how do you decide which markets for instruments to focus on at any given time? For example, bonds, treasury notes,
yeah,
equities, whatever.
Well, I'm
FX.
I'm an FX guy, but I look at all assets. It depends on the why. It depends on what's moving markets. Obviously, we had a big carry unwind with yen.
Depending on the macro?
Yeah, it depends on the macro, but it depends on what's moving it as well. So sometimes, and also the DNA of it. I mean, sometimes I quite like euro dollar. It can be a bit frustrating, but sometimes that fits with where I'm at.
Simply because of the volatility or something else?
No, it's just everything. Like, it's the macro, the interest rate differentials, it's the volatility, it's the central bank divergences. And these are options that come and spring about. A recent thing is interesting actually about the RBA in Aussie. They seem to be quite hawkish, and their data's pointed to be quite sticky. And that is being a bit of a divergence between different assets, different crosses. So that's something that's coming. It's been quite interesting for me personally. But yeah, it just depends. I mean, it's I tend not to trade the yen crosses. I'm okay on dollar yen, but because of the volatility, I'll calm that down. But yeah, I mean, it's just how I feel as well. And I look at where I've really gained, and and what's performed best for me and what's reliable, especially with the correlations.
Do you have any example of how any specific event has affected your trading strategy?
Yeah. I mean, dollar CAD in Q1 was a faded paradise. So on every bit of CPI, and our clients really gained a lot from this, we faded it. And if you look, we do this thing called mini mapping with our clients. So we
Mini
map
mapping.
out, yeah, so we map out all of the moves with the reactions, and use that on a really nice glossy PDF map of the chart. And you know the chart I use is TraderMate, so that it's very clean and it's really gorgeous actually. So we use that with our clients. We go through the reaction of minor and major data on CAD, and we faded it. You know, we went against the move, and you can see that it happened, I'd say 85% of the time in Q1, probably about 65% of the time in Q2. And we made a lot of money out of it.
By the way, what platform did you say?
The charting is called TraderMade. That's the chart we use.
TraderMade?
TraderMade, yeah.
Let me
They're
write
they're
this.
great. They've been going since 1985.
Cool. Cool. So, in the world of FX trading, what does what's your take on algos and AI and the combination of the human factor with AI, algos, and so on?
Look, it's always going to be around. AI. We were talking about AI at the trade ticket event actually, with some big funds, and
Well, AI is everywhere,
it
so
yeah, AI is everywhere, but we've had AI in a different name for years. We've had, you know, machine learning, HFT. We've had, neural learning. We've had the race to
yeah.
zero. It's not new, for us. So it's been around for decades. It's only a big thing in like the creative industry now. It's like turning people out of jobs and all this stuff. I mean, at the moment, the funds I was talking to, some of them, yeah, multi-billion-dollar funds, they do not use AI. They do.
They're not?
It's too no, of course not. They do
Why
it
not?
to write that because it's not reliable. They do it to write the analysis of, if say it's a systematic fund, but they need to code it, and you need someone who knows what they're doing, and backtest that rather than an AI to do that. And will it grow in the future? Absolutely. Right now, we're still in the early stages, so it's yeah, we'll see what happens next year.
It will be involved, but will it be better? Well, that's a question.
Yeah, Tudor said, and I opened with this on the trade tech event. Um, Tudor from Tudor, the huge hedge fund, said there is no human better than a machine, but there is no machine better than a human with a machine, and that really nails
Absolutely.
it for me.
Yeah. And what about crypto?
I avoid. I did really well
You do?
prior to FTX, but I'm not involved with that at all. It's too risky, and you know what? I like to sleep at night, and there's too much. There's too
It's too
many.
much.
Uh, is
Yeah.
too many. There's too many people who get really emotional about it and think you're attacking them. You can't have a healthy debate on LinkedIn about it. Yeah, people. If you say some one
True.
bad thing about, they think you're personally attacking them. It's not healthy. So yeah, I just avoid crypto.
Yeah. It's a wise decision, by the
Yeah, exactly.
way.
There's a lot easier. I don't trade oil. I used to do. I used to. I don't trade gold. I just stick to FX. It flies a lot straighter.
Cool. So, given your extensive media presence, by the way, including appearance on BBC and so on,
Yeah,
how do you balance your roles as a trader, mentor, and public as a media person, public financial expert?
yeah, really badly. um, I just do what I want to do, really, and that's I have a nice mix, and sometimes it gets too much. Like this week has just been crazy, but now I've got a couple of weeks. I'm doing it. I'm going to Dubai in a couple of weeks, and that'll be lovely. I'm going to spend a nice week with my friend in his villa, just chill out. But I do enjoy all the aspects, and sometimes it gets too much, and then I just hold off, and sometimes it gets it's fine, but it's all good fun to me. It's all I do is talk about markets, so um, it's absolutely fine. And then all of a sudden it will be Christmas. So yeah, that's when. And I take August off as well. I mean, I do some blocking stuff, but I don't trade, and I'm away from the markets. And things like Christmas week, I take off. So I make sure I have a lot of holiday. And that's just how I choose to do, really.
Patrick, any last advice, like a book, a quote?
Yeah. Yeah, absolutely. Look, I've got a great plug. Basically, if you like what you've heard and you want to spend 1 week with me completely free, now's your chance. So I'll send you the link. If you just bear with
Cool.
me, I'll sort of get it in my essentially on the in October, it's the 14th of October. And I'm going to send you the link in the chat. It's the 14th of October, and it's basically if you want to know what we do, how an institutional trader works, now's your chance. So there you go. You've got the link there. It's 1 week with me, and
Got it.
you get to know what we do, how we work, and basically, we're asking for a £997 marker. It's fully refundable, no ifs, no buts. Why are we doing this? Because I like free stuff and I press yes to free stuff. What this means is you'll actually turn up, participate, and we've got a very finite amount of places on this. And really, it's you to get to understand how an institutional setup works. And really, at the end of it, if you didn't get maximum value, you're not going to be, trading on that. Absolutely get your full refund. It's just a pleasure, but it just means that you're serious and you want to do this. And we've had a few sign-ups already, so we're launching out on the 14th, and we're looking to maybe towards the end of the week those places will be running out. So you've got the link, and that's really it's no risk, and it's only upside. And at the end of the week, you might think, what, it's not for me. Stick with your retail stuff. So, but you might think, look, what, I'm just going to try this. I've got no risk, and you'll get to know me and my team, and you'll get to know how it really works.
Cool. Patrick, it was a pleasure. Thank you. Thank you very
Thank
much.
you, Alan. All the best. Yeah.
Absolutely. Bye-bye.
Bye now.